Let me introduce on the show then Mr. PV Subramanyam of Subramani.com. Thank you so much, Mr. Subramanyam. Always a pleasure having you with us to talk finances on the Money Show. To start with, Mr. Subramanyam, like I said, I think diversification will be the name of the game. It always is the name of the game, really, when it comes to efficient financial planning, cutting down the risks, cutting down the concentration risk. So let's talk then about this asset class of commodities and alternative assets. The retail participation over here is the bare minimum. In fact, it's absent in many of these categories of asset classes that I'm talking about. Do you think that they're a good addition?
I don't know, because in commodities there is more trading than investing. You cannot really buy these commodities and hold them for life. The only commodity which you do buy and hold would be gold or silver, maybe some platinum. I don't think you can hold any of the other commodities. So largely you are trading. Now, trading requires a completely different mindset from investing. So maybe somebody could invest in the commodity fund, but dealing directly with commodities, I think it's a no-no. Well, definitely not possible as an investor. You cannot buy oil and store and do things like that. You can take 30 days, 90 days kind of position, but you have to always settle in cash, right? You will not be able to take delivery of those things. So no, investing in commodities doesn't happen, but trading in commodities just happens. So retail investors' only exposure to commodity would be gold or maybe silver. But beyond that, I don't think they can do any investing in commodities.
Okay, all right. So it's usually used as trading. Nevertheless, what's interesting is, and a very popular platform, of course, MCX has reported that they have seen a big surge in retail investors trading now in the commodities market. That's what their data is indicating. So I suppose just how now equities has seen a big retail participation, direct equities, even commodities in many ways are seeing a significant surge in participation from retail investors. The principles with respect to FNO more or less do carry forward, but I think for commodities there are so many other moving parts. So do you think that for retail investors, most of them, of course, like we've spoken before, are already now trying their hand out with equities now that fintech has made life so much easier? Do you think that they should venture out in commodities then, this category of individuals?
Again, like I said, if you make a distinction between investors and traders, there can't be investors in commodities. There can only be traders in commodities. Whereas in equity shares, suppose I tell you buy 10 shares of a particular company every month, you're going to take delivery of that. You're not going to take delivery of commodities. That's the difference. So yes, trading, yes, people are doing it in big numbers, because those prices are far more difficult to manipulate. You cannot really manipulate the prices of oil or gold because it's an international commodity. So there you are much better off than a particular share, like you could rig up a share or bring down the share. So that can't happen. It's a much bigger market, much broader market. You have to be on your toes 24/7, especially if you take big positions. So I know people who hardly sleep, right? So yeah, but those are traders. Let's not call them investors. Those are traders. Those are professionals. They make a lot of money. I do not know whether the amateurs will make that kind of money. If you go wrong in an equity share, you can at least take delivery. Here you can't really take delivery. You have to settle it on the settlement day for a profit or a loss, whatever it is. So yes, a lot of trading is happening. I agree. Even in the equity market, a lot of trading is happening. But yeah, you shouldn't confuse the traders and the investors. Trading mindset is very different. It requires to be very sharp, nimble-footed people only who can trade. Investing is much easier. You can put 100 rupees a month or 10,000 rupees a month or whatever amount you want in an index fund. You can't do that in commodities. In commodities, you have to buy and sell. Therefore, you're much better off in a commodity fund. Or if you look gold as a commodity, yes, an SIP in gold is possible. But in other commodities, such things are not possible.
So basically, in India at least, when you want to sort of dabble in commodities, you'll have to be a trader. We don't have, there are no investors in commodities, long-term investors like you do have for equities, where, buy a good quality company's shares and then, sit tight and let the, the power of compounding or, its gains essentially, or it's your patience rather reap your rewards. If you participate in the commodities market, you essentially will be participating as a trader, and you'll have to then constantly keep track. So if you do not have the bandwidth, the wherewithal of doing so, then it's best avoided, I suppose, or else you'll have to, dedicate more time and energy behind the entire activity. And let's not forget that the commodity market in India is, by the way, open virtually all day, maybe just a few hours of shut shop at night when you're asleep. So literally it's open all day, and I suppose it makes it easier as well for a lot of individuals once they log out of work than to trade in commodities. But like I said, it's an activity that requires some learning, and then maybe you can sort of get the hang of it. Let's talk about alternative assets. It's an asset class that's kind of confusing. Many people don't know much about it. But Mr. Subramanyam, are your clients talking to you about it? Is there any sort of interest? And again, do you think that this, is a space that I think it's high time retail investors as well look at?
Alternative investments would just mean people, funds which can take much bigger positions and who can move across asset classes. So you can have an AIF which has got equity and debt and real estate, which can be like a flexi cap fund, which can move across very fast. And yes, it requires bigger amounts of money. Yes, people do invest. But really now in the market, real good asset allocation is to sell when the market is high. But people would now not be wanting to sell equity and buy debt because debt yields are low. Very difficult to convince a person to reallocate assets, which means to sell assets which are doing well and buy assets which are not doing well. Asset allocation demands that. So yes, it's difficult, but yes, people are investing in a good time. It is easy to get people to invest. So yes, other alternative investments are happening. Real estate is also seeing some interest, but I don't see them picking up in a big way simply because people are not willing to get out of. See, to get into some other commodity, you have to be willing to get out of equities. That willingness is not so much visible. So yes, it is difficult, but yes, alternative assets are good assets to look at.
Mr. Subramanyam, is there a barrier in terms of the minimum investment amount for some of these alternative assets that maybe retail investors should know about?
I mean, if you're talking of an AIF, you're talking of 1 crore. But there are other, see, you can always look at some other exposure, you can look at foreign equity funds. You can look at a fund of funds which invest in other countries. That is again an alternative to investing in India. However, equities all over the world seem to be bloated. So really, what would you look at? If you ask people to sit in cash, that is not again attractive because your fund will all start giving 2%, 3% kind of return. Companies are able to raise money at 2.5% for the short term. So since other alternatives are really not attractive, that is what is perhaps holding back people from going into it, even any of the foreign assets. But yes, if you see, the number of people willing to invest abroad has gone up a lot. Some people have been doing for 6-7 years, but many people who have entered in the last 1 or 2 years could get hurt if the dollar moves. And if the dollar weakens, they will lose money which they have invested in US. So yeah, those assets are being explored and being explored in a big way.
Okay. How would you look at the inherent riskiness of these asset classes? What I want to understand is, do you think that there would perhaps be a section of investors who may not be having the appetite for an asset class like this?
Absolutely. See, the question is how much money you have, whether you have already met all your goals and you've provided for all that. You cannot really invest with basic money which you require. Let's say you require 5 crores for retirement and you're 55 years of age or 57 years of age and you have only 5 crores. You really can't afford to take risk in a class of assets which you do not understand. Unless you're willing to invest in learning, which could even be equities. If you are not willing to invest in learning, I would say stay away. If you can learn, if you can find a good advisor, sit with him and then see what are the risks in these kind of investments. Luckily, many mutual fund schemes are available which invest across countries, across asset classes. They would have debt and equity exposure, commodity exposure, that is World Energy Fund. All these funds are there. You're better off going through the mutual fund route, especially in products which you don't understand. And all these funds have given some fabulous returns in the last 1 or 2 years. Don't use that as an indicator. But yes, because you have, let's say 5 crores is completely in equity and debt, you want to add some commodities, you want to add some real estate. look at mutual fund options rather than trying to go directly, because this is really difficult to understand.
All right, mutual fund options definitely are the way to go, and it's always sort of better to understand, invest in things that you do understand rather than getting into complexities. And this financial world can really lure you with all their complexities and the promise of good returns, etc. But I think it's sometimes better to keep it simple, and that's the clear-cut clarification from Mr. Subramanyam as well. So, if we have to just keep it in the theme of diversification, then, Mr. Subramanyam, how would you recommend people move beyond equities and equity mutual funds? If you had to curate sort of a portfolio with a mix of all the asset classes available out there, how would you sort of curate it?
I would look at mutual funds which have commodity funds. They have World Energy Fund. There is World Mining Fund. There is a World Gold Fund. A mining fund does better than a gold fund because there is leverage of the company also available, the PE of those companies which are available, which makes it more attractive to invest. So look at those assets. Look at investing in foreign countries like, say, Japan, China, Europe, Asia. Funds are again available. US. These funds are available. You could invest across them. And there are oil funds which are available, and like I said, commodity funds. So look at all those and look at it in a small way. 70% should still be India-oriented equity and debt, and in about 30% you can take risks, including gold and other assets. Many of them would have done well. So go to the mutual fund, see which foreign funds are available, what are they doing. Many Indian manufacturers like DSP and ICICI have those kind of schemes. Have a look at them, see how much you understand, and do an SIP with a 5-year, 10-year kind of view. During this, all cycles will be met, and that will give you some diversification out of pure and India-centric fund. But beyond that, you don't need to do anything. But also remember that beyond 3 years only, you will get capital gain. It will be taxed like a debt fund, and therefore you have to understand that you have to have a 3-year, 5-year view, at least I would think a 10-year view. And an SIP way of investing makes sense because all these funds are now giving very good returns in the immediate past.
Okay. All right, understood. So there you have it, folks. I hope this gives you sort of a gist on how you can diversify your portfolio across the different asset classes that are available. And if you have any questions at this juncture, I'll take it up with Mr. Subramanyam. So shoot them to us. Our email address is themoneyshow@etnow.tv. So I think we can move to our Ask the Money Show segment. Our very first question, a very interesting one at that, is coming in from Shakir Sheikh. He asks, I had a query. My requirement is that I do not want to invest in mutual funds that further invest in financial services like banks, housing finance, etc., which earns interest and is forbidden in my culture. Thus decided to diversify my portfolio with different sectoral mutual funds like pharma, tech, consumption, energy, resources. Would you recommend I diversify my investment as so in such different sectoral funds, thereby reducing the ups and downs of sectors? This is a very interesting one, actually. So instead of buying a large cap fund or a mid cap fund, he actually is looking at sectoral funds. We've seen pharma IT funds do very well. He wants to avoid funds. He wants to avoid maybe large and mid cap funds because all of them, in fact, have at least one banking stock in their portfolio, at least one, in fact, if not a majority. So how would you recommend folks like Shakir Sheikh essentially go about their mutual fund planning? Because this cuts down quite a few options before them.
Yeah, so it's very difficult. I was just going through, I don't think that you can find any mutual fund scheme which does not have any bank or NBFC or housing finance company. So I would look at Sharia-compliant investment schemes and put money into that, because for him to identify such themes is very difficult. So suppose pharma has done well or IT has done well, that is not enough reason for him to put money in those funds, right? So he's better off looking at some Sharia-compliant scheme, and then he hopes that the fund manager knows how to look at Sharia-compliant companies and invest in those funds. So that must be much easier for him to invest than trying to find schemes which will suit. Because choosing thematic funds for oneself over the long term or the short term is not going to be very easy. In fact, for any investor, we recommend that these sectoral funds are not more than 5-10%, maybe 15% of their portfolio. Whole 100% can't be in sectoral funds, it is too risky. So yes, that is very risky, but that does not mean you cannot look at Sharia compliant companies. Or maybe you should look at some companies which he knows, like looking at a pharma company rather than just a pharma fund. IT companies also give their money to mutual funds or to banks, keep deposits, so they do have interest income. You cannot eliminate interest income from such companies. So best is to go into a Sharia compliant portfolio and invest in that. That is easier.
Mr. Subramanyam, for the benefit of our viewers and all the other viewers interested, what sort of Sharia funds are available in India? Which are the mutual fund houses offering this option, or do all of them at least have one such fund?
I think there are. I'm not sure, but I think there are Sharia compliant funds. So I'll have to Google a bit, but I do think Sharia compliant funds are available in India. I do not know the specific schemes.
Okay, all right, fair enough. You can just contact, you can always contact your advisor as well, and he or she will be able to guide you. There are many mutual fund houses. As far as I am aware, I vaguely remember SBI mutual funds having a Sharia compliant fund, but I think it's best that sort of, you sit down, especially because I think when you'll have to sit with financial planning, you'll any which ways need a lot of help, from a personal finance advisor, since you have a very crucial requirement from your portfolio. So it's best if you, sort of consult an advisor as well. Okay, Ranjan Barik now writes into us saying, I've been doing my SIPs in a mix of large caps and mid caps for the last 4 years. Now my advisor says move everything to liquid funds, which I find weird because liquid funds is for short term, as your channel says so. Why is he saying this? I have been investing for wealth creation and long term. Okay, this is a twist in the tail, if you could call it that, Mr. Subramanyam. And yeah, he's right, because we usually say, and liquid funds are used not just by retail investors, but more so by corporates and institutional guys to, for money management and treasury operations. So, would you be able to explain the rationale, if any, if you're able to find here?
Typically, what happens after an investment advisor has been advising for some time, he suddenly thinks he's become a fund manager and he knows how to take market calls. So he might have looked at his portfolio and said, "Oh, you made a lot of money in equity, so I need to move it to liquid and wait for the market to come down and then I will invest." This is a completely criminal advice. Don't do this. However, if you have some goals which are within the next 2-3 years, that money should move into ultra short bond fund or something like that. Only if you have a requirement within the next 45 days should that move into liquid fund. If you are anyway investing for the long term wealth creation, that's absolutely no reason for you to move everything into liquid. But yes, if you think you got 78% return in a fund and 84% return in fund, you know this is not going to get repeated. Be ready for the IRRs to come down to 11-12%, which is the average over long periods of time. But if you think you can time the market, you are mistaken. It is extremely difficult. That is for the fund manager to do. Let him do it. So moving a part of your money into liquid fund or ultra short bond fund makes sense for any short-term requirement. Or if you are to book some profit to buy some other assets, then it makes sense. Otherwise, if you are a long-term investor, this doesn't make sense. But I know people who say shift it into a liquid form and a fund and then do a systematic transfer. That will lag your portfolio if the market goes up further. So look at your asset allocation, what you are comfortable with. If you need to remove money from equity and move it into liquid fund as a part of your asset allocation, that makes sense. But also understand that almost all the debt funds will give you returns in the range of 2-3%. Maybe if interest rate goes up, your fund will also lose value. Remember all that while you're making the move, but moving into liquid fund does not make sense. Mubina, 1 second, I got an answer. For the earlier one, Sharia compliant, there's a Reliance Sharia fund, there is Tata Sharia fund, and Taurus Sharia compliant fund. So there are 3 funds available, and the Reliance, which is the Nippon fund, is an ETF. So yes, those are the 2-3 options which are available. State Bank of India, I'm not very sure.
Yeah. Okay. In fact, my producer as well, just sent some interesting information on that. And yes, like Mr. Subramanyam mentioned, limited number of funds, but these are some of the options that folks like Shakir could consider. Okay, I think we have time for one more question, so let's take that. Chetan Shetty writes in saying, how many mutual funds are ideal for a long-term portfolio of, say, the next 5 years? Secondly, what should be the ratio of the different fund types? He says he's ready to take certain risk and the total corpus he has to invest is 50 lakh rupees. So I think he's not invested his 50 lakh rupees anyway yet. This is his starting point. He's ready to take on some risk. He's not mentioned. I assume that his goal is just to, deploy this money in a return generating asset as opposed to leaving it maybe in a savings account. So yeah, Mrs. Subramanyam, where would you get him started?
I don't like he's contradicted himself by saying long term and said 5 years. At this market, when the market is pretty high, if you're looking at 5 years, not more than 20-25% of your money, maybe maximum of 30% of your money can be in equity. The balance has to be in debt funds, because you do not know if the market falls from here, how quickly it will be able to recover. So one large flexi-cap fund like Franklin Flexi-Cap or HDFC Flexi-Cap, which used to be called the HDFC Equity Fund earlier, one of those or in the back kind of a thing, that's what I will invest, maybe across 2-3 funds, yes, but largely a fund orienting towards 70%, 65-70% in debt only and 30% in equity. So either 70% he puts it into 4-5 debt funds and 30% he puts into some large cap, some mid cap and some small cap. This is not a market for him to be investing in a lump sum. So again, an STP through a liquid fund is what I would do in equity. And I would try to increase that 5 to 15 years. He says long term. When he says long term, it has to have a long term bias, which means it has to have a 10-year, 15-year, 20-year kind of a thing. And 5 years is considered to be short term. So I wouldn't put too much money in equity. But yes, one flexi cap fund, one ultra short bond fund, one short term income fund, and maybe one large cap fund. That's all I would stick to. I would even be scared of small cap and mid cap who have had a good run up now.
All right, Mr. Subramanyam, thank you so much then for joining us on today's edition of the Money Show and helping our viewers out with their questions.